Hi, everyone. Welcome to the Weekend Charts, where I run through the most important charts and themes in markets and investing. Huge show today, a lot to discuss. Today's show is brought to you by my friends at YCharts. YCharts is an investment research platform that enables smarter investments and better client communications. It's built for advisors, asset managers, and smart individual investors. Take a look at the show notes for a link to a free trial to YCharts and let them know I sent you to get 20% off when you first sign up for the service. So let's start out by, of course, talking about that inflation report. We got an unpleasant surprise to the upside. Inflation overall came in at 8.3% year over year. The market was expecting 8%. Difficult reaction in the stock market. It was down over 4% that day. That's the biggest decline we've seen since June 2020. The big concern for market participants is that core rate of inflation moving higher. So core CPI, which excludes food and energy, up to 6.3%. That's the highest we've seen since March. And what's going on there? How did that core rate really move up so much? Well, the big driver was really the shelter component. So shelter's over a third of the CPI index, so very important. Over a third of consumer spending for the average household is on housing. And what we saw there was an increase from 5.7% in July to 6.2% in August. So significant rise, pushing up the core rate. That wasn't the only thing moving higher, of course. If we're looking at all different categories, major categories, we had food at home moving up 13.5%. That's the highest we've seen in this cycle. We had things like medical care starting to move up here, up to 5.6%, highest we've seen in this cycle. And importantly, not all commodities have come down. Most of them have, but drivers of electricity and drivers of gas utilities which would be natural gas, has not come down, and so that we saw rates of inflation increase in both of those areas as well. So overall, difficult report to stomach, and as we've talked about, the actual rate of inflation is likely higher than what the reported rate is because of this understated shelter component. So anybody who's been looking at rental increases, home price increases over the last year would probably say this 6.2% number seems really low. And if we look at rents, we're still seeing a 10% increase on the year over year. We're still seeing record highs in terms of rents, and we're seeing home prices up 18% year over year as of June. So what we have going on here is the weird way that the CPI shelter component is calculated. Again, it's using this owner's equivalent rent, where they go out and ask people what they think their house would be should rent out for. And the way that's being calculated is it's showing a lag to what's actually going on in the market. So even though the rate of home price appreciation has slowed considerably, so this number is going to come way down. If we look at next month, we're actually seeing, as we'll talk about in a little bit, nationally home prices off of their peak that they hit in June, and we're seeing rents actually now decelerate. So this 10% year over year increase is the lowest we've seen in some time. So we're going to see this weird situation where actual housing inflation is decelerating while the reported housing inflation and CPI is moving higher still. And so what we're likely to see because of that, because of how important that shelter component is elevated rates of CPI until that catch up is complete. And so the question would be, when is that going to complete? I'm not sure. I guess it would depend on how quickly it catches up and how close it actually gets to that actual housing inflation. I'm not sure if it's ever going to get to what we actually saw over the last 2 years. But for the time being, it seems like the trend for that is still higher, which is going to support at least a base level of inflation above what people are kind of expecting. So even if things like gasoline come down, and hopefully if things like food prices come back down in terms of the rate of inflation, even if that happens, what you're going to see is that core price being supported by this higher shelter component, the way it's calculated. So we'll watch that closely in the months to come. The Fed is very focused, of course, on that core rate, So then the worry for market participants, and one of the reasons why the stock market reacted the way it did, down over 4% that day, was the expectation that the Fed is now going to have to be more aggressive. And so we'll talk about that in this next part, where the single most important chart in my mind in the economy and for the Fed is this following chart, which is looking at real average hourly earnings. So just basically taking average hourly earnings, the increase year over year, and comparing it to the rate of price increases. So comparing it to CPI. And now for 17 consecutive months, we've seen a negative rate of real average hourly earnings, which basically means inflation higher than earnings for 17 consecutive months. And why this is a problem, of course, you know it, I know it, everyone knows it who's been buying things. Well, your purchasing power has gone down. It's a decline in prosperity because your wages are not keeping pace with higher prices. And this is the primary reason in my mind that the Fed needs to continue to hike rates, because this is an untenable situation. You can't have prosperity in a nation where inflation is outpacing the rate of increase in people's wages. So you need to get that inflation number down. And what the Fed is likely to do now, at least according to the market, is be more aggressive in the next few months in terms of hiking rates. So the expectation now is pretty much solid for that the Fed next week is going to hike 75 basis points. I think there was some debate whether it was going to be 50 or 75 before this inflation report. Now, market's pretty convinced the Fed's got to do 75, bring the Fed funds rate back over 3%. And then from there, the expectation in November shifted to another 75 basis points increase in November, which was above where it was before the inflation report. So overall, we've just seen a shift higher in terms of the expectations, with another 25 basis point increase baked into the expectations. So interesting thing, if we look at the Fed funds futures curve, if we're looking at the expectations over the next few years, what the market's saying is Fed's going to be very aggressive in the next few months. Then they're going to stop at some point in the first quarter of next year at above 4% here. And then by the back half of 2023, they're actually going to be cutting interest rates. They're going to continue to cut rates in 2024. And that probably comes as a surprise, or might be shocking to you. Why in the world would the Fed be cutting rates next year when we have this huge inflation problem? Well, it's going to be, in my mind, be twofold. One major reason is going to be the economy. They're going to be acknowledging the economic slowdown that's already going on. And two, that slowdown is going to bring down the rate of inflation, like we saw, as we talked about in the last video, as we saw during the 73 74 period when inflation spiked and the Fed hiked rates. We had a recession, inflation rate came down. And as we saw in the early 1980s, we got a pair of recessions that finally broke the back of inflation when the Fed was a tightening monetary policy. So is the economy weak enough today where the Fed would become closer to a pause? Well, that depends on how you look at things, I think. If we're looking at retail sales, which is very important, of course, for the U.S. economy, big driver of economic growth is U.S. consumer spending. And it's really a tale of two pictures here. And one picture is the nominal rate of increase in retail sales, which is unbelievably strong at 8.9% over the last year. But the other story, the other tale is when you adjust for inflation. And after taking out that 8.3% increase in prices, what we see is a very modest 0.6% increase in real retail sales. So two different stories here. We're close to kind of flat growth if we're looking at real retail sales. And in my mind, this would be lower if not for two factors. And those two factors driving keeping this number higher than it likely would be otherwise are the savings rate and consumer credit rate. So what's been going on over the past year, while prices are outpacing wages, is two things. The consumer is making a decision, A, to save less. So if you save less money, you have more money to spend. And two, they're borrowing more. You borrow more money, you have more money to spend. So far, what the U.S. consumer has chosen to do is not really reduce their spending very much at all. but save less and borrow more to fund that. So we're seeing the lowest savings rates we've seen in the US since 2009, highest increases in consumer credit we've seen since 2011. So those two factors are really supporting the economy for now. If they go, then you have what's so far a mild recession in terms of real GDP turns into something worse. In terms of what the Fed hikes are going to do to interest rates, if you're a saver, this is very good news and something you probably haven't seen if you have a savings account in quite some time. And because of that, you're probably, if you're like most Americans, sitting in a savings account that's still earning next to nothing. So if we look at all the big major banks, they're still giving a yield of close to zero. And the national average savings account is around 13 basis points. But meanwhile, I just checked the highest savings rate available now is up to 2.61% if you go with an online bank. And if the Fed does indeed hike 75 basis points, as they likely will, we're going to see this rate over 3% by next week. So go online if you're earning 0% on your money. This is one of the few free lunches that exist in markets where you can actually bump your rate of return up from 0 to 3%, I think, by next week without taking any more risk. So these savings accounts are FDIC insured. So if the bank goes under, if you have less than 250,000, if you're an individual, or 500,000 if you're a couple, you're going to be fully insured. And you can get that higher rate of return just by doing a little work, finding the bank that has that return, which next week there are going to be a number of banks, and opening an account and transferring your money. So if you're still earning nothing on your cash, definitely get moving. And in terms of longer term savings, so if you have money that you can lock up for 1 year, the returns are going to be even better there. We're looking at 1 year treasury bills now up at 3.92%. Which we haven't seen a rate that high since October 2007. So nearly 15 years you have to go back to see interest rates at a 1 year period be this high. And so we're seeing across the board from where rates were when they started the year, from 1 month treasury bills to 30-year treasury bonds, just higher rates across the board. The biggest increases have been here at 1 year or less compared to where we were at the end of last year. But everything is seeing an increase. And what we're seeing here, if we look at a table of treasury yields going back to 1990, is really a normalization, right? So we had this period after 2008 where, at least on the short end, the Fed was close to zero, again, except for that brief period in 2018, pretty much close to zero this entire time. That helped drive everything else down. The Fed was doing also quantitative easing for most of these periods as well. All these factors helping keep interest rates low. And now we're seeing the opposite situation where thus far it's really just been a normalization. So it's kind of like interest rates are seeing a reset here to where they were before now the financial crisis. So not really anything extreme. It just feels extreme given where we were for all of these years. So if you're, again, a saver and you're looking to make a higher rate of return on your money, now these are the best rates that you can find in quite some time. So is it just treasury rates that are going higher? No, we're seeing rates across the board go up. And I think the most significant one to talk about for the economy, of course, is that mortgage rate. And so what we've seen in the mortgage market this year is almost unprecedented. We haven't seen a spike this much this fast since the early 1980s, and we've never seen it off of these very low levels. So we had mortgage rates in the past year more than double. So now we're over 6% for the 30-year mortgage. You got to go back to November 2008 to find a 6% mortgage in the US. And it wasn't that long ago where we hit an all-time low here of 2.65% in early 2021. So just a stunning move higher in terms of the mortgage rate. Number of factors driving that, of course. Number one being Fed policy in terms of interest rate increases. Number two being the Fed has stopped buying mortgage bonds now, finally, and their mortgage bond balance is now going down. So they're not reinvesting these bonds when they come due. So the Fed is getting out of the mortgage bond buying business, which, as we've talked about, was a kind of a crazy thing for them to be doing over here because the housing market was so strong and didn't need that additional fuel on the fire. So, what does this kind of reversion to the mean and then some for the mortgage market mean for the housing market? Well, it's going to mean, I think, a reality check because of that affordability equation. So, I put together these numbers here to really make it clear how much affordability has declined in the past 2 years. So 2 years ago, we had a 30-year mortgage rate of 2.87%. And the average new home price in the US was 405,000. Today, you have that 30-year mortgage above 6%, so more than doubling, and you have the average new home price at 547,000. So doubling of the mortgage rate, significant increase in the home prices. The result of that is twofold here. Number one, you have $28,000 increase in what is necessary for a down payment. So assuming 20% down, you have this higher home price. You're going to have to pay $28,000 more for that down payment. And the bigger factor here, 96% increase in that monthly payment. So enormous, enormous difference in the monthly payment due to that higher housing price and due to the higher mortgage rate. And keep in mind, this doesn't include things like property taxes, insurance, utilities, repairs, and maintenance, which have all really seen significant increases as well. And if we included them, I think this cost comparison would be even wider. So what is this doing in terms of the housing market? It's leading to really a significant slowdown in terms of transactions and demand, as we talked about last video. And we're starting to see the initial stages of a price decline, 6% nationally so far from the peak in June. And as we're heading into the slower fall and winter seasons, I think the expectation would be we're going to see continued weakness to come. And this is going to be a big factor for the US economy because housing not only tends to be an important leading indicator for the economy, there's a spending component as well. When the housing market's doing well and people are buying new homes and moving, they tend to spend more money on their homes and buy new things, and that helps the economy. And now we're going to see kind of the reverse of that. So very important factor here, looking at the housing market. Now, let's switch gears and go back to that inflation report and talk about the really one positive area of the report. And I think that would be the decline in gas prices. So pretty significant decline now that we've seen since the peak in June. We're down to 371 per gallon nationally, which is around a 26% drop from where we were in June. And so this is helping the CPI, overall CPI, come down. It's certainly helpful to anybody who's driving to work or took vacations this summer, and at least in August, to see this go down. It's going to filter through other areas of the economy as well. And at the same time, we're seeing this go down. We're seeing the U.S. continue to tap their strategic petroleum reserves. So these are the reserves that we hold of crude oil for emergencies, and it was deemed that this situation, this inflationary spike, was an emergency. So we've really lowered the amount in the reserves by selling off the strategic petroleum reserve over the last year by a pretty rapid pace. And just to illustrate that on the chart here, we're now at the lowest level since 1984 in terms of the number of barrels in this U.S. Strategic Petroleum Reserve. And if we look at a calendar year basis, I broke it out here in terms of percentage changes by year. We have never seen a decline of this magnitude in a calendar year, over 25% decline in the petroleum reserve year to date, and there's still a few months to go. So if we look at these two charts, one might say, well, are we seeing this decline in gas prices because of the increase in supply from drawing down these reserves? And it's tempting to assume that a big part of this decline might be because of that. But if you look at the actual data, it's not likely to be as big of an impact as you might assume, just because the market for oil is so enormous globally. So you're looking at 100 million barrel a day consumption globally, and the U.S. has kind of added less than a million. I think I calculate around 700,000 barrels a day over the past year in terms of additional supply from drawing on this reserve. So really less than 1% of the supply that's available for consumption is coming from drawing down this reserve. So is there an impact? Maybe marginally, but not a huge impact likely overall, because it's a global market and this is just not big enough, frankly, to move it that much, even as much as we did. And then I guess the question is, even if it has helped with bringing down the price of gasoline in the short run, if we're going to replenish these reserves, let's say next year or the year, is that going to then drive whatever the price is of gas back up in the other direction? It's impossible to say because there's so many different factors affecting that price of crude oil at any one point in time. Supply is one factor, but demand, particularly during periods of economic weakness, can be the more important factor. And so what we're really seeing here in terms of the decline in gas prices is that reality of a global economic slowdown really setting in. And particularly the slowdown in China has led to a big reduction in demand. China is the biggest importer of crude oil. And so the slowdown in their economy is really having an impact in terms of the demand side, which has lowered the price of crude oil globally over the past few months. If we look at longer term in terms of U.S. supply, I think for for the last 50 years, basically, we had this policy. It didn't matter if it was a Republican or Democratic administration. Policy was kind of increase energy independence, and a big part of that was kind of increasing or promoting U.S. oil and gas production. And this is a chart here showing you the amount of federal acres that are leased for oil and gas production in the first 19 months of different administrations over the years. And as you notice here at the bottom, what's been different about this administration has been just the lack of leases. And this was something that President Biden promised when he was running for office, that he was going to essentially not issue any leases. They went back on that in June after a lot of pressure, given the price of gasoline moving higher, but it's still just very minimal. And the interesting thing about this chart is it takes years for once you lease this land for oil and gas production to ramp up. So we're not going to see the impact of this really reduction here for years to come. And so I think it'll be a question that people are going to be debating, an important one. Europe is going through their own situation as well today, much worse than the U.S., where they became overly dependent on Russia for their energy needs. And now they're having a very difficult time because of that. So I think this is going to be, regardless of how you feel about long term, I think we all would hopefully want to be independent in terms of our energy resources. Just how do we get there? And the reality is we still rely on oil and gas for now for a big part of our energy needs. So we can't immediately go to these kind of alternative sources of energy because we're just not there yet. The energy production from wind and solar is not nearly enough to meet the demands of the U.S. economy every day. So it's going to take time if we're going to transition to these other areas, and we have to be mindful of that. So this is just an interesting chart here. We won't know for years to come what the impact will be, but I think there's going to be more and more of a debate about that, of how we should approach that energy independence in the future, and how to promote really lower energy costs for the American people. What's the best way to accomplish that? Because if we're going to have a real time view of how Europe responds to this, and I think there's just growing angst over there, and for good reason, that perhaps they've gone too far in the direction of reliance on Russia and other countries. And so maybe there's going to be pushback where they start producing more of their own energy. So this is something extremely important, and hopefully you find a good solution for the American people, because you don't want to have the situation where you're spending just a huge amount of money on your gas, electricity bills, and so on and so forth, because it crowds out investments, obviously, in other areas of the economy, productive areas. So hopefully, this is something that's resolved for the benefit of all of us. I want to talk about quickly the hidden cost of COVID. This was just an alarming chart that the Wall Street Journal had an article about, which is the math and reading scores for US students, 9-year-old students, the decline in their math and reading scores from 2000 to 2022, largest that we've seen in decades. So I think math, they said, was the largest that we've seen. You got to go back to the 1970s, and we haven't seen a decline this large. And reading was, I think, in 1990. You have to go back to see something similar. And what was the driver of this? Probably not surprising: pandemic shutdowns, quarantine periods, remote learning that really wasn't effective for a lot of students. A lot of students got left behind. The most vulnerable students, the ones most in need of help, the ones with learning disabilities, really suffered the most during this period of time. And what this article in the journal was talking about is that people are predicting that's going to take decades to kind of resolve this gap, this loss of learning for this group of students. And hopefully it doesn't take that long. I think we need to talk about it more, make this a national priority, give these students the resources they need to catch up, whether it means doing extra schooling in the summer, whatever, longer hours. We owe that to these students. I think in large part we failed them by keeping schools closed for too long in many different areas, and now we're just seeing the results of that. I think to many of us, we knew that this was going on; it just wasn't being talked about. So hopefully, we come to a decision nationally and make this a priority, because decades from now, we're going to see the results of what happened during this 2-year period in terms of these students falling behind and not being able to catch up, and then that leads to lower economic earnings for them for their lifetimes. And so let's make this a priority. Let's try to focus on it, and let's try to find ways to close that gap. Um, this is something I think that nobody really talks about, but I wrote an article on it on the blog recently. And the question is, can you earn bond-like returns without seeing drawdowns? And that might seem like a fanciful concept, but why is it important not to see drawdowns? Well, it's psychological. If we look at the bond market this year, it's down over 11%. That's going to be the worst year in history unless something crazy happens in the next few months, by a wide margin. And if we look at drawdowns for the US bond market, we've never seen a drawdown this long. It's almost the deepest drawdown that we've had in history. You have to go back to the early 1980s to find a larger drawdown. And importantly, bond investors are not conditioned to assume that this is a reality that they should have anticipated. So bond investors are thinking these are these safe securities. I'm not going to lose much money. Maybe I won't make much money, but I'm not thinking about you're going to have 10% drawdowns or more from these securities. And when you have a mismatch between expectations and outcomes, what you have is what you tend to often see in investing is negative behavioral responses. So people are likely, those same bond investors who are looking at their portfolios, a lot of them might be saying, well, I just can't stomach this. What am I doing? I'm just going to sell out of my bonds, my bond funds, because this is too much. I can't believe that there was such a big loss here, and something that I saw was safe. So going back to that question, is there an alternative for bond investors who can't stomach these types of short-term losses, right? I say short-term because, yes, eventually the bond market will come back. Right now, you're earning over 3% interest. Might take a few years, but bond investors will eventually make that money back. But was there another way, and is there another way today for bond investors who can't stomach these types of declines to earn a return over the long run that's similar to kind of the safer areas of the bond market? So in the stock market, we know that's not possible. You have to take risk. You have to take drawdowns. It's the price of admission for higher returns. If you look at risky bonds, same thing is often true. You can't have the higher returns from high yield bonds without taking more risk. But if we're looking at kind of investment grade securities or better, and that's kind of what this aggregate index is there a comparable product where you don't see drawdowns? Again, this is not something a lot of people talk about, but it's something I wrote about in this article, is certificates of deposit. So these certificates of deposit are basically just savings accounts where you lock up a fixed amount of money for a fixed time period. You can do it at your local bank. They're not likely to give you the best rate, but if you go online, similar to the savings accounts, you can find a better certificate of deposit rates. And so I went around and I looked at the yield, the best yield I could find on 1, 2, 3, 4, and 5 and 10-year certificate of deposits, and compared it to the yield on the AGG ETF, which is one of the largest total market bond ETFs. As you can see here, you're getting a yield that, at least for now, if you get the best CD rate, is higher than the AGG yield. So the interesting thing here is that with AGG, with any broad bond fund, you're going to see principal fluctuation. You're going to see drawdown. So in this case, this year, you're going to see a loss of over 11%. In a CD, what you see only is that the principal balance goes up. So any type of so if interest rates rise from here, if you have this 10-year CD, yes, the value of your CD is going to go down, but you won't see it. And so psychologically, that might be better for a lot of investors. Now, why wouldn't everyone just pick a CD over something like a broad bond fund? There's a number of reasons that might apply, and I just list a few here. One would be liquidity. So a CD, you're locking it up for that term. If you want to get your money back before the end of that term, and you have to pay this interest penalty, and that'll depend on the terms of your CD. A bond fund, of course, or bond ETF is going to be very liquid. An ETF you can sell intraday, and so if you don't want to lock your money up for a period of time, you might go with a bond fund versus a CD. Two is effort. This is an important one as well. With CDs, yeah, the CD will come due at some point in the future. If you have a 1-year CD a year from now, you're going to have to think about that again. And that bank might not have the best rate at that point in time. And you might need to go and find a new bank and then transfer the money and get a new CD. And not everyone wants to go through that effort. Number three, taxes. Taxes are an interesting one here with the CD. You're taxed at the federal and state level. With a bond ETF, if it's a treasury bond ETF, so mostly treasury securities, most of that interest is not going to be taxable at the state level. So if you live in a high tax state like California or New York, you might be better off going with treasuries or a treasury bond ETF over CD because of the tax implications. And these last two here can be helpful or hurtful depending on how you look at it. Again, you're not immune from rising interest rates with the CD. You just don't see that price decline. But also, if you think interest rates are going to rise over the next year significantly, you might not want to lock up a CD rate today. You might want to wait because you think you'll get a better rate in the future, and you don't want to be locked into that lower rate. And then if you believe interest rates are going to fall and you want to profit off of that decline in interest rates, you'd be much better off to buy something like a bond fund because you're going to see that price appreciation in that case. So that's what we saw in 2019 and 2020 when you had these broad bond ETFs up 7-8% in both of those years. It was because interest rates were declining and you benefited from that. And so this year we're really seeing just a reverse of that, right? A reversion to the mean, as we've talked about, with yields going up and prices coming back down. So over the very long term, if we're looking at 10, 20 years, it probably wouldn't make any difference in terms of returns if you went with CDs and rolled them, let's say, or if you went with a bond fund. But in a short period of time, you could see very different outcomes. Could be better, could be worse. I think the point that I'm trying to make in this article is simply, if you're the type of investor who's going to panic and sell out of a bond fund because its principal is going down, CD might be a better option for you, because even if it is going down in value, you don't see it, and therefore you're less likely to bail on that. You're more likely to stick with it. And the best investment strategy is not necessarily the one with the highest return. It's the one that you can stick with the longest and really benefit from long-term compounding. So interesting thing there. Check out that post. I'll have a link to it in the show notes. Let's move on, talk about the global slowdown. And again, this was, in my mind, the big reason why you're seeing commodities, if you look at copper, but also crude oil, many other commodities coming down, is the global economic slowdown. And really, we're just starting to see it in the statistics. So we have second quarter real GDP growth, still positive in most places, but if you compare it with 2021, we're seeing a slowdown in over 80% of major economies around the world. If we look at the US, 5.7% 2021 real GDP growth. The year-over-year rate now is down to 1.6%, and that's a difference of around 4%. And as we talked about, the first two quarters were actually negative for the US in terms of real GDP growth. So it's not just the US. We're seeing broad-based declines, as we talked about. China being a very important one, and their response to COVID is a big factor driving this in terms of they still haven't really abandoned the zero COVID policy. And as a result, we're seeing a significant slowdown this year, 7% difference from what they reported economic growth to be in 2021. So what's going on? Why is economic growth slowing? Well, the U.S. is not the only country that's dealing with higher inflation, and the U.S. is not the only country that's trying to bring inflation down through tighter monetary policy. So what we're seeing is a very different picture than what we saw a year ago. So I put together these two tables here that I often tweet out, updates in terms of central bank policy. On the left side is September of 2021. As you could see, a year ago, inflation was rising almost everywhere at that point, but you still had banks not moving to a tightening monetary policy. So you had more banks with their last move as cutting rates as opposed to hiking rates. If we look at the picture today, almost everybody is on board in terms of hiking interest rates. The Bank of Japan, China, Russia, and Turkey being the exceptions. Everybody else hiking interest rates. You have ECB moving off of negative interest rates, Denmark moving off of negative interest rates. So some big shifts in policy. And we have inflation rates today much higher than they were a year ago. So important point here is global tightening is not yet done, particularly in the developed world, where, as we've talked about, these central banks are far behind the curve. So if we look at the Bank of England, 1.75% versus 10% inflation. The ECB, 0.75% versus 9% inflation. So more hikes are coming. This is likely to lead to more of a slowdown from the economy because there's a lag in terms of policy. When there's a lag on both sides, there's a lag when you cut interest rates and how that helps the economy in the future, and there's a lag and central bank policy when you hike interest rates and the impact on the economy. So we haven't seen the full effect of interest rate hikes that have gone into effect so far this year. And there's going to be more hikes to come, particularly in the developed world. We haven't seen the impact of that as well. So last point here, I want to end, as I like to do, on a positive note. This is an interesting one, fascinating thing to witness is something known as Moore's Law. And this guy, Gordon Moore, he's one of the co-founders of Intel in the 1970s, came up with this prediction, and he said that the number of transistors on a microprocessor would double roughly every 2 years over time. And this is kind of the formula used to predict. So your processing power in a future year is going to equal your processing power today times 2 raised to the number of years. And basically, assumption was that it's going to double every 2 years, and that that's going to equate to a 41% annualized growth. So just huge exponential growth and progress. And I think that very few people thought it would actually come to fruition for this long. And so I went back and looked at the numbers in terms of the over time, the number of transistors on a microprocessor starting in 1971. and all the way to this year. Just enormous exponential growth in technological progress, something to be that we should all celebrate. And that, how did Moore's law, like, how did his prediction, how would it have panned out? Let's say if you put this 2300 number into that equation, what would it have predicted to be the number today in 2022? And this is what the result was. So not too far from the actual number. And so pretty astonishing. We don't often talk about good news because it happens so slowly. And, as rapid as this is going on, there's improvements every single day. And this is just not newsworthy enough. It's not something that happens overnight, which is how bad news often travels, and it's why you tend to see more of a focus on bad news than good news. So I think this, for the human race, this has been enormous. Just think about of the processing power of your cell phone today versus what would have been necessary to do that same thing on your phone in 1970. You would probably need a computer that would fill a whole room, and now you can do it on this little tiny device. So I think there are doubters today saying we've come a long way. How much can we really improve in the future? And perhaps this rate of growth slows down in years to come, but by no means is it over. If you give people uh, freedom to invent, and you reward them for that, we're going to continue to see improvements in the future. So, as Larry David would say, pretty good in terms of Moore's law and predicting the advancement in semiconductors. And so, with that, we'll end it there. Have a great rest of your week. Thanks everyone for joining me, and we'll see you next time.